Look into Warren Buffett, the Oracle of Omaha.
Oh, yeah.
We're talking investment moves or, well, maybe the lack of moves lately.
Right.
That's what's got us intrigued.
Right.
We're basing this whole thing on this YouTube video. It's from New Money. It's called Warren Buffett's Hidden Warning to Investors for 2024.
Interesting.
I mean, this guy's a legend. Everyone knows that.
Absolutely.
But he's been awfully quiet, like unusually so. So what we want to figure out is why. And, see if there's anything us regular investors can learn from this whole situation.
Right.
Even if our portfolios are a tad smaller, right?
Yeah, tad. It really is quite something. You'd think with all this market volatility, a guy like Buffett would be all over it, snapping up all those bargains.
Exactly.
But there's this surprising thing. The video highlights, it's like his top 10 stock holdings, they've barely budged over the past year.
Yeah.
They even show 3 lists from different quarters, and they're basically identical.
So that's pretty unusual for him, right?
Yeah. Oh, totally. I mean, this is Warren Buffett we're talking about. He's famous for being a value investor.
Right, right.
Someone who swoops in, when great companies are undervalued. But right now, doesn't seem like he's finding anything tempting enough.
So why not? What's the deal?
Well, the video, it points to a few reasons.
Okay.
The first one's pretty simple, straight from the horse's mouth. Buffett himself, he says in the video, no elephant-sized acquisitions. At least not at prices he's willing to pay.
Uh-huh.
He even uses the words sky high when he's talking about prices.
So he thinks the market's too expensive, basically.
Pretty much.
Like he's at a fancy buffet, but all the food is like way overpriced.
Perfect analogy. Even billionaires have their limits, right?
Yeah, I guess so.
Yeah.
But this is where that whole value investor thing comes in.
Exactly.
They wait for the right opportunity,
They're patient.
not just chasing the latest trend.
It's like, think about it. You wouldn't buy a car for double its price, right? Buffett's looking at the market and seeing a lot of, overpriced cars.
Okay, so maybe some overpriced cars, but is the entire market really that overvalued?
That's a good question. I mean, isn't it supposed to go up over time in the long run?
Right, that's what they say.
Yeah, that's the general idea, but it's not always a smooth ride up. There are signs, things are looking a bit pricey right now.
What kind of signs?
Well, they use this thing, the S&P 500 Shiller PE ratio in the video. It's a way to measure if the market is overvalued or undervalued, historically speaking.
Okay.
And right now, it's sitting around 37.
37, right?
And historically, it should be between 18 and 20.
So yeah, that is a bit of a difference.
Yeah, things are looking a little inflated, you could say.
Okay, so I can see why Buffett's being cautious then. But, I mean, this must be especially tough for him because, Berkshire Hathaway, it's huge.
Absolutely.
You can't just buy a few shares here and there. It's got to be big moves, right?
Exactly. Huge bets to even make a difference in the portfolio.
Exactly. He needs those elephants.
Exactly, the elephant-sized deals.
And remember, if he owns over 10% of a company, then all these regulations kick in.
Oh, yeah, all sorts of hurdles. So not only is the market expensive, but he also needs to find these massive deals.
Tough combo.
Yeah, it's a real challenge.
Okay, so we've got expensive stocks. That's one reason he's holding back. What's the second thing the video mentions?
This one might surprise you.
Okay, hit me.
Treasury bonds.
Treasury bonds.
Yeah.
Really? That doesn't sound very, Oracle of Omaha to me.
Yeah, I know, right?
It's usually like super conservative investors, people just trying to protect what they've got.
Right. But it's not always that simple. You see, while treasury bonds are seen as this safe haven asset, they can also be a strategic play, especially, in certain economic situations.
Okay.
You have to remember, a treasury bond, it's essentially you lending money to the U.S. government.
Oh, right, like those IOUs we learned about in school.
Exactly. And you get interest payments in return.
Yeah. But I always thought those returns were pretty low.
They used to be, yeah. When interest rates were near zero, bonds just weren't that attractive.
Right.
Especially compared to stocks.
Yeah.
But now things are different.
How so?
Interest rates are hovering around 4.5%.
Oh, wow.
So suddenly, treasury bonds, they offer this pretty decent return with very minimal risk. And actually, the video shows this graph of Berkshire Hathaway's bond holdings. It's clear Buffett's been putting more money into them.
So it's not that he's suddenly gotten scared of risk.
No.
It's more like the game's changed and he's adapting.
Exactly. What used to be boring, now it's a smart move. I think that's a good lesson for all of us. What's considered a good investment, it's not set in stone. It changes, with the times.
It's fluid.
Yeah,
Yeah.
exactly. And for our listeners, I think that's really important to remember how these changes, interest rates, how they affect your portfolio, even those safe investments you've got.
Okay, so we've got expensive stocks. That's one. We've got these suddenly attractive treasury bonds. What's the third reason Buffett's hitting the pause button?
This one, it's a little harder to pin down. It's like this general sense of unease about what's going on in the world.
Hmm. So even the Oracle of Omaha is feeling a little unsure about things. I don't know, is that reassuring or what?
Well, it means we're not alone.
Right.
That's for sure. They actually quote something Buffett said in the video. It was at the Berkshire Hathaway shareholder meeting earlier this year.
Oh, okay.
He said, "With everything that's going on in the world at the present time, I don't mind at all under current conditions building the cash position."
Oh, wow. That's a big yellow flag, isn't it?
Kind of, yeah.
Yeah.
But what exactly is making him so uneasy? It's not totally clear.
Yeah, but I mean, there's a lot going on, right?
There is. There's a national debt, for one.
Yeah, that's a big one.
And then you've got all these geopolitical tensions, the U.S.-China trade war, the war in Ukraine, conflicts in the Middle East, you name it. It's a lot of instability to think about.
No kidding.
Yeah.
Not to mention, inflation is still hanging around, and some people are talking about a recession.
It's like a perfect storm of uncertainty.
It really is.
Yeah.
It makes you want to batten down the
It
hatches.
does. And while, Buffett's pretty famous for not making predictions, this statement, it suggests, to me at least, that he sees all this global uncertainty as a good reason to be cautious. Hold back a bit.
I think that's a good lesson for all of us, whether we've got millions invested or, just a little bit. It's not about panic selling everything. It's about checking in with ourselves.
Yeah.
Our risk tolerance. How comfortable are we with things being, well, volatile?
Exactly.
If Buffett's being cautious, maybe we should be too.
Absolutely. Sometimes the best move is just to wait and see what happens.
Okay, so we've got three solid reasons for why Buffett's being so inactive. Pricey stocks, those unexpectedly good-looking treasury bonds, and, well, the general feeling that things are a little shaky in the world right now. But there's actually another factor the video brings up, and it's something people often forget about when they're talking Warren Buffett.
Oh, you mean the fact that Berkshire Hathaway, it's not just an investment firm?
Exactly. It's easy to forget that they're this massive insurance company, too.
Right. And that part of their business, it has specific needs. They impact how Buffett manages his cash.
Because they need to have enough money to pay out claims, right? If, say, there's a huge hurricane or a massive earthquake, something like that.
Exactly, yeah. Insurance companies, they have to be ready for the worst case scenario.
They do.
And they actually say in the video, Buffett has said publicly that he keeps at least $30 billion in cash on hand just for this purpose. Untouchable, he calls it.
$30 billion. Wow, that's a pretty big just-in-case fund. But I guess when you're insuring that much stuff,
You've got to be prepared for anything.
you really do.
Yeah.
So while we're all busy analyzing what stocks Buffett is or isn't buying, we have to remember there's this whole other side to the equation.
Absolutely.
Keeping those insurance operations running smoothly, it's not just about finding great investments. It's about managing risk, making sure Berkshire Hathaway can handle anything, both literally and figuratively.
Right.
Okay, so we've covered a lot here. Let's do a quick recap before we move on. 4 main reasons for why Buffett's inactive. First up, expensive stocks. Even those companies that look good in the long run, their prices are just too high right now.
Yeah, he's a value investor, remember?
Exactly. And there aren't many value picks to be found right now.
Not at the moment.
Then we've got those treasury bonds looking pretty good thanks to those rising interest rates.
It just goes to show good investments can change. We have to be able to adapt.
Absolutely. And of course, we can't forget that feeling we all have that the world's a little bit uncertain right now.
Geopolitical tensions, the economy, it's a lot to take in.
It really is. And finally, the insurance side of Berkshire Hathaway. Can't forget that. They need to have a lot of cash on hand in case something big happens. Even the best investors have to balance opportunity and risk management.
Absolutely.
Okay. So that's why Buffett's doing what he's doing. But what does it mean for the average investor? What are the takeaways? We'll get into all that in part 2 of our deep dives. Welcome back to our deep dive. In part 1, we were digging into why Warren Buffett's been so quiet in the market. Expensive stocks, appealing bonds, that global unease we're all feeling.
Right, and don't forget that whole insurance side of Berkshire Hathaway. They need a ton of cash on hand, just in case.
Yeah, $30 billion untouchable. That was pretty eye-opening.
It is, isn't it?
But now I'm really thinking, okay, what does this all mean for us regular investors? We're
Yeah.
not exactly buying up companies like Buffett, but are there still lessons we can learn?
Absolutely, tons. Even though we're not dealing with billions, his strategy can teach us a lot.
Okay, lay it on me. What's the first lesson?
Patience. Gotta have it. Not just in life, in investing, too. Buffett, he's the king of waiting for the right moment, even if it means sitting on a pile of cash for a while.
So resist that urge to jump on every hot stock tip.
Yeah, don't chase trends.
Focus on the long game.
Exactly. Play the long game, just like Buffett. Don't let fear or greed make your decisions for you.
Right?
Take your time. Do your research. Be patient. The right opportunities, they'll come along.
I like that. I definitely need to work on the patience part. I get a little FOMO sometimes.
Love it.
Okay, patience is key. What else? What else can we learn from the Oracle?
Be a lifelong learner. That's a big one. You see, the market, it's always changing. What worked yesterday might not work tomorrow.
Right.
Buffett, he reads constantly, always learning new things.
He does. Always trying to stay ahead of the curve.
Exactly, and we should too. Whether it's reading, listening to podcasts like this one, going to seminars, keep learning, stay ahead of the game. The more you know, the better decisions you'll make.
Makes sense. Knowledge is power, especially when it comes to investing. So be patient, keep learning. What else? What's next on the list?
Think for yourself. Don't just follow the crowd. Buffett, he's famous for this. Thinking independently, going against the grain.
Yeah, he doesn't just accept conventional wisdom, does he?
Nope. Always questioning things, looking for a different angle, not afraid to be contrarian.
So be a skeptic. Be curious. Think differently. I like it. What else? What else can we learn?
Remember, investing, it's not just about making as much money as possible. It's about managing risk, too.
Right. Not losing money.
Exactly. Buffett's a master at this. Look at how he's doing things now. Lots of cash on hand, ready for anything.
Makes you feel a bit safer, doesn't it?
It does. So understand your own risk tolerance. Don't put all your eggs in one basket.
Diversify.
Yes, diversify. And don't overextend yourself. Chasing those risky investments for a quick buck, it's usually not the best strategy. Slow and steady, protect your capital.
That's good advice. Okay, so we've got patience, continuous learning, thinking for ourselves, managing risk. It's a lot to think about. But let's go back to that expensive market we were talking about.
Okay.
The video used the Shiller PE ratio as an example.
Okay.
Can you break that down for us a little more?
Yeah.
What's it actually telling us, and how can we use it?
Sure. So remember, the Shiller PE ratio, it's basically a way to see if the stock market is overvalued or undervalued compared to, well, history. It takes the current price of the S&P 500 and compares it to the average earnings of those companies over the past 10 years, but it adjusts for inflation.
And right now, it's way higher than the average. That's why Buffett's being so careful, right?
Right. When the Shiller PE ratio is high, it could mean the market's getting a bit bubbly, a correction might be coming. It's not a perfect predictor, though.
Okay. But it's something to pay attention to.
It is.
So if the market is expensive, does that mean we should just, I don't know, not invest at all?
Not necessarily. Remember, Buffett's not selling everything he owns. He's being patient. He's being selective.
So we should be too.
Exactly. Even in an expensive market, there are still good opportunities out there.
So what's the best way to approach it then, this expensive market? Should we be looking for certain types of companies or industries?
This is where value investing comes in. Instead of going for the hot, trendy stuff, you look for companies that are fundamentally strong.
Okay.
But maybe the market's undervaluing them right now.
So how do we find those companies?
Look for strong financials, good management, a company that has a real edge in its industry.
So basically, do your homework.
Yeah, analyze the numbers. Don't just buy into the hype. Look for those hidden gems that everyone else is missing. And remember, patience is key here. Value investing, it's a long game.
Okay.
You might not see big gains right away, but if you choose well, those undervalued companies, they'll catch up eventually.
Right. Makes sense. So even when the market's expensive, there are still opportunities out there. But what about those treasury bonds Buffett's been buying? They're looking pretty good right now, aren't they?
They are, especially with interest rates the way they are. Remember, bonds are basically loans to the government. They pay you interest. When those interest rates go up, well, the yields on bonds go up too. Makes them more attractive.
So how do we know which bonds to buy? Are all treasury bonds the same?
Not exactly. They come with different maturity dates, some just a few months, others 30 years. The longer the maturity, the higher the interest rate usually.
Okay, so if we're looking for something safe with decent returns, treasury bonds could be a good option.
They could be, especially if you want to spread your risk, diversify that portfolio.
Diversified, right.
But it's important to remember, like any investment, bonds have risks too.
What kind of risks?
Well, inflation's one. If inflation goes up faster than the interest you're earning on those bonds, your returns get eaten away.
That makes sense. Anything else we should be aware of?
Interest rate risk. If rates go up a lot after you buy a bond, its value could go down.
Okay, so we need to understand how interest rates work before we jump in.
Definitely. Do your research, talk to a financial advisor, see if bonds make sense for you.
All right, so we've talked expensive stocks, treasury bonds, patience, learning, thinking for ourselves, managing risk. But let's talk about that global unease for a minute.
Okay.
We mentioned the U.S.-China trade war, the war in Ukraine, all those tensions. But are there any specific economic things we should be worried about?
Yeah, there are a few. Inflation, for one.
Right. Even though it's cooled down a bit, it's still a concern.
It is. Central banks are raising interest rates to try and control it. And those rising rates, well, they can affect the whole economy.
They can.
Another thing to watch is economic growth. There are signs that the global economy is slowing down.
And some people are even talking about a recession.
Right.
So there's a lot to take in. But how do we make sense of it all? How do we apply this to our own investments? Where do we even start? I guess that's what we'll tackle in part 3, right?
Yeah, in part 3, we'll talk about some practical steps, some things you can actually do to navigate this market.
Okay, so we're back for the final part of our deep dive into Warren Buffett and his investment moves. Or should I say, lack of moves. It's been quite the journey, from those super expensive stocks to, surprisingly, those treasury bonds looking pretty good.
Not to mention that whole feeling that things are a bit shaky right now. Even Buffett's feeling it.
Yeah, and we've learned some good stuff along the way.
We have.
Remember, patience. Keep learning. Think for yourself. Manage that risk.
Right, those are like our investment mantras now.
Exactly.
But I'm still a bit lost on what to actually do.
Yeah.
It's a lot to take in, the expensive market, maybe a recession coming, bonds looking good. So where do we even begin? How do we actually use all this info to make good investment decisions?
That's the key question, right?
It is.
Because knowing stuff, but not doing anything with it, well, it's not going to get you very far. So let's take what we've learned from Buffett and turn it into action.
Okay, I'm ready to move from learning to doing. What's the first step?
Look at your investment strategy.
Give it a checkup, like you would with your car or something. Does it still work for you, for your goals, your risk tolerance, with how the market is right now?
So basically, step back and see if our game plan still makes sense.
Exactly. Maybe your goals have changed, maybe you're more or less comfortable with risk now, or the market's just doing something totally unexpected. Whatever it is, you got to make sure your strategy is still going to get you where you want to go.
Okay, reassess the game plan. What's next?
Think about your cash.
Cash, okay.
This is where we can really channel our inner Buffett. Remember, he's got a mountain of cash right now, just waiting for the right moment.
He does. He's like a lion waiting to pounce. But does that mean we should all be stuffing cash under our mattresses?
No, not exactly. It's about finding the right balance for you. Having some cash on hand, it gives you options. You can buy when everyone else is selling.
It's like an emergency fund, but for investing.
Yeah, exactly. You can be more opportunistic. You're not forced to sell at a loss if things go down. You can buy low, like they say.
Okay, so have some cash ready to go. What else?
Don't be afraid to look at different types of investments. Remember, Buffett's been buying those treasury bonds. They're offering pretty good returns right now, and they're relatively safe.
Right. Bonds are suddenly cool, but are they right for everyone?
Not necessarily. It depends on your goals, how much risk you're okay with. But it's a good reminder to be open-minded, Think outside the box. Look at real estate, commodities, maybe even some alternative investments.
So diversify, right?
Exactly. That's the key to managing risk. Don't put all your eggs in one basket.
Right. If one thing goes bad, you've got others to cushion the fall. Okay, I'm getting it. Diversification is important. What else can we do to deal with this crazy market?
Stay informed. Be ready to change. The only thing that's constant in the market is change. What works today might not work tomorrow. So keep up with what's happening, in the world, in the economy, anything that could affect your investments.
Don't be an ostrich. Head in the sand.
Exactly. Read the news, listen to podcasts like this one, follow the experts, and be ready to adjust your strategy if you need to.
Okay, so stay flexible, ready to change course if things shift. Got it. Any final words of wisdom?
Don't panic.
Don't panic, okay?
Easy to say, harder to do when the market's going crazy. But remember, Buffett, he's seen it all. And he's not panicking. He's being patient, thinking long term.
So we should too. Breathe, stick to the plan, and remember, the market always bounces back eventually.
It always does. Slow and steady wins the race. If you follow these steps, you'll be in good shape no matter what happens.
This is all great advice. Thanks for explaining everything. I feel a lot more confident now, like I actually have a plan.
Glad to hear it. Remember, the key is to stay informed, think for yourself,
Yeah.
and never stop learning.
That's it for our deep dive into Warren Buffett's world. Hope you all enjoyed it and learned something new. Until next time, happy investing.